We turn now to a story that cuts straight to the heart of Washington's evolving industrial policy and the political resistance building around it. A brand new CNBC poll reveals that approximately 50% of American voters view U.S. government equity ownership in private companies as inappropriate. That is a striking threshold, notably higher than analysts had anticipated, and it lands at a moment when the Trump administration is actively pursuing strategic equity stakes across key sectors. Markets had broadly assumed public resistance would be minimal if these moves were framed around national security or infrastructure necessity. That assumption now looks fragile. The hard data point here is clear. Approximately 50% of voters surveyed in the CNBC poll consider government equity ownership in private companies inappropriate. That is the single most important number in this story because it establishes a political ceiling on how aggressively the Trump administration can pursue its industrial policy toolkit without triggering legislative friction. No prior consensus polling existed for this specific measure, which means market participants had essentially been pricing policy implementation as a lower-risk path than reality now suggests. The opposition level at 50% is the kind of headline that gets read on Capitol Hill before committee votes on appropriations and investment authorization. The deeper issue here is not just one poll number. It is what that number signals about the durability of state capitalism as a policy instrument in a divided political environment. When half the electorate views government equity stakes as inappropriate, the administration faces a real constraint. Every new equity position it takes in a private company becomes a potential attack surface for opposition lawmakers. Programs dependent on sustained government investment commitments. Think CHIPS Act semiconductor subsidies, clean energy manufacturing credits, and defense procurement arrangements all carry implementation risk that was previously being treated as near zero by equity markets. That repricing of political risk is what investors need to model now. Defense contractors are the most directly exposed names here. RTX, Lockheed Martin, and Northrop Grumman all operate inside a procurement and partnership ecosystem where government equity involvement, or the threat of it, reshapes contracting terms and valuation multiples. The broader industrials complex tracked by industrials faces headwinds if government ownership becomes politically toxic, reducing Washington's appetite for co-investment structures. On the rates side, long-term treasuries is the instrument to watch. The 10-year treasury yield sits at 4.54% this morning, down 61 basis points, suggesting some flight to safety already in motion. If policy uncertainty deepens, bond demand accelerates, and that yield compresses further, creating a rotation dynamic away from cyclicals and toward defensive fixed income. There are three specific things to track from here. First, the 10-year treasury yield at 4.54%. Any sustained move lower would confirm a risk-off interpretation of this political signal, while a reversal toward the upper end of the policy-driven range would suggest markets are discounting the opposition. Second, the VIX at 17.84 is subdued today, but the industrial policy debate escalating into legislative gridlock is a credible pathway to a volatility spike. Third, and most importantly, watch the congressional calendar for any markup sessions on investment authorization bills. Those committee votes will be the first real test of whether this 50% opposition translates into legislative obstruction that actually delays or shrinks the administration's equity stake program. Here is the one-sentence version of what matters. This 50% voter opposition threshold represents a genuine constraint on the Trump administration's industrial policy toolkit, and investors who have been treating government co-investment as a tailwind for defense contractors and subsidy-dependent sectors need to reassign a higher risk premium to implementation uncertainty. The broader market is trading lower with a risk-off tone providing context for today's moves. Monitor legislative action on equity stakes as a leading indicator. It will price in faster than the poll itself. That is the one story driving political risk in markets today. Full breakdown is up. If you want this level of analysis every single trading day, specific tickers, key levels, and the macro context that actually moves portfolios, hit subscribe right now and turn on the notification bell so you never miss a breakdown. We publish every market day, and the depth you just watched is what every episode delivers.